we're saving today in order to support our future lifestyle. And a big goal for many investors is to actually keep pace and ideally outpace inflation.
Yes. Yeah.
Yeah.
That's the big goal. And if we take it back to, for instance, the comparison between an individual like you and I and our families going out into the market, what we want is we want the utility of the goods and services that we acquire. We recognize that the prices of those goods are going to go up over time. And so we have to match that with the type of assets that will accommodate that kind of inflation. And what I'm talking about here is, I'll give you an example, buying a piece of real estate, for instance, that will go up in value to match inflation and also provide rental income that we can use. That's the real estate comparison. But in the stock comparison, for instance, we want to buy shares of companies that are producing a valuable good or service and are going to give us a rate of return. Now, that's going to be expressed either as a dividend that we get, or it's going to be expressed as a growth in the value of those shares over time, over and above inflation. We're going to need to match the investments that we invest in with the challenges that we face out in the marketplace. And stocks and equities, including real estate, they tend to do that over time, even though they fluctuate. But there's one asset that doesn't quite do it, and that's a bond, right? That's ownership versus loanership. That
Well,
bond is
there's the
you
bond, but there's also cash, which is the
know,
worst of the versions.
well, yeah, we need to begin with that. Take, $100,000 and stuff it underneath your mattress in case somebody, or just put it into a safe or something. It's not going to do anything for you.
Yeah.
You can draw on it. It's not going to give you a rate of return. It's not going to keep pace with inflation. That's the worst asset to own,
Yeah.
right?